But our next guest sees some signals of a pullback in the underlying positioning. Here with us now is S3 Partners founder and managing partner Bob Sloan with our guest host Sarat Sethi. Bob, it's good to see you. Talk us through this. And incredible, this ETF launched and has exploded. So some kind of a pullback people are positioning for that would be expected. But what do you see? Well,
DRAM got to $10 billion faster than any ETF ever. And the short interest got to almost $1 billion faster than any short interest metric that we've been watching in the last 22 years.
Wow.
Ever. So you just have a battle of wills. There's just obviously a massive rush to memory chips, to the memory sector, and you have a lot of negative bets against that.
But when you see the $1 billion are short, so somebody's in a lot of pain. And at some point, they either cover or they go deeper. Where can you get a window as to, are these hedge funds, are these individual investors, mutual funds, and what does your data say kind of for the next few weeks as to how that's going to happen?
So if you looked at Micron and Qualcomm, for example, you would have seen that the active investor, whether that was hedge funds and or mutual funds, have been underweight and or pulling back their investments over time. What you've seen is that the index investor has just plowed money in. So index equals momentum. And you have the active managers pulling back, both at the levered investor and the unlevered investor is actually pulling back. So momentum is driving all of these stocks. It's a one-way bet, all on the flows of money coming into indexes.
So if I'm an individual investor watching, what advice would you give them to say, if somebody says, I'll give you two scenarios. One is, I have no exposure to this. What's actionable for me in terms of, I'm not talking shorting, but like, should I buy?
Yeah.
Or, wow, I own a lot of this, and I own it because either I bought it like short lead time ago and it's done up, or I bought it 2 years ago and now it's 4 times what it is.
Well, price is the question. The answer is positioning. And so if you look at what positioning means, it's like looking at the facade of a building. Right? That's the price. And what you want to know is what's going on inside the building. So what our data shows you is that if the index flow stops, the market will go down. It's really that simple. So you have to watch the flows of indexing in these stocks. So for example, Qualcomm is at 30%. It's a 5-year high. Micron, a 5-year high. You can look at almost any one of these stocks. Indexing is a 5-year high. It is a mechanical function rather than a valuation function that is driving stocks.
Well, that would sound anything that's mechanical. It sounds like you could take the other side of that.
Well, but people don't. So, and that's the point, right, is that they're underweight. So if we looked at, for example, hedge fund buying over the last quarter, you'd see that their long positions, 28% of hedge fund long positions are in information technology. That is underweight to the index. Their short interest is 32% of all short interest. So that is at index weighting. So they're skeptical about where the market is going to be going. They're actually, the levered investor is shorting the flow coming in from indexing.
And interestingly, if you we were talking about the last few weeks where the Mag 7 have underperformed. Have you seen a trend there, in the semis? Because we've seen the semis go like this and software go like this. So what are you seeing in there?
Short interest in take Micron, Qualcomm, they're at 5-year highs.
Wow.
They've almost tripled in the last year. I mean, that's your answer.
But I'm surprised people are willing to bet again. Now, I know it'd be a hugely rewarding bet if they were to turn and drop a significant amount. But trying to time that, it reminds me a little bit of like Tesla in the olden days. Like
100%.
You might think this makes no sense, or at some point it's all going to turn around. But in the meantime, you can lose a lot of money that way.
That's exactly right. And that's exactly what happened with Tesla, because 0 is the biggest number in business, right? As soon as they could actually take their free cash flow and actually invest it in the business, the shorts lost a ton of money, right? A lot of people went out of business. So I think if you look at these things and say, okay, the active positioning is underweight, both for the mutual fund and hedge fund, short interest way up, indexation way up.
Where do you think that's pointing?
Yeah, where do you think that's pointing?
Yeah.
It almost answers itself.
In other words,